Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because right now there is a disconnect happening in this market that most retail investors are not seeing, and I want to be precise about this. The public sentiment on XRP is at its lowest point in months. Retail investors are bored, frustrated, and quietly selling, but here is what makes that so significant. While retail was selling, whales were buying. On-chain data confirms that institutional buyers quietly accumulated over $520 million worth of XRP during a single dip. $520 million in one accumulation window. And the Bitwise CIO, Matt Hougan, just went on record confirming exactly this pattern, stating there is a massive disconnect between retail sentiment and professional investor positioning. Professionals are extraordinarily bullish, while retail is capitulating. Stay with this analysis because by the end, you will understand exactly why institutions are paying for XRP that retail is handing away, and what the $27 trillion unlock they are positioning for actually means. Let us start with the psychology, because this is where the trap is being set. Retail investors operate on a simple framework. If the price is not moving up, something must be wrong. If weeks go by without a breakout, the conclusion is that the thesis is broken, and so they sell. Quietly, without drama, they move on. And that is precisely the behavioral pattern that institutional accumulation programs are built around. The goal of smart money is never to buy when everyone else is buying. That is when prices are high and supply is scarce. The goal is to buy when retail is exhausted, when sentiment is crushed, and when supply is freely available at the lowest possible cost basis. The $520 million whale accumulation did not happen despite the retail pessimism. It happened because of it. Every retail seller created the supply that the institutional buyer needed, at the price the institutional buyer wanted. The boredom is not a sign that the market is dead. It is the operating condition that institutional programs require to run. The Bitwise CIO's public statement deserves more than a headline mention, because Matt Hougan is not a crypto community figure making bullish predictions for engagement. He runs the asset allocation and research function for one of the most credible institutional digital asset managers in the US market. When he states on the record that there is a massive disconnect between retail sentiment and professional investor positioning, he is describing what his firm's institutional clients are telling him directly. Those clients are not looking at daily candle charts. They are looking at regulatory timelines, ETF flow projections, and settlement infrastructure deployment schedules. And what they are seeing from that institutional vantage point is the setup for a significant capital allocation event. The retail investor who sold during the same period that produced a $520 million single window whale accumulation did not take a neutral position. They transferred their XRP to an entity that has already decided where the price is going. Now let us talk about the regulatory picture, because this is where the story changes character entirely. For 10 years, Ripple was on the defensive, fighting the SEC, navigating legal ambiguity, operating under the shadow of an enforcement action that created uncertainty for every institutional partner evaluating XRPL infrastructure. That period is over. Brad Garlinghouse has secured a confirmed seat at the CFTC's CEO forum. Read that again carefully. Ripple is not attending a CFTC hearing as a defendant or as a company being questioned. Ripple is sitting at the table as a participant, helping to design the regulatory framework that will govern the next generation of US derivatives infrastructure. The specific focus of the CFTC pilot program is tokenized non-cash collateral, the mechanism by which trillions of dollars in derivatives margin obligations will be satisfied using blockchain-native assets, rather than the slow, capital-intensive legacy infrastructure that the US derivatives market currently depends on. Ripple is writing the rules. That is a different company than the one retail investors have been selling. The XRP Depository Receipts, now live through Anchorage Digital, represent the infrastructure development that removes the single largest barrier to institutional XRP adoption that has existed since the asset was created. XRPDRs allow family offices, registered investment advisors, and large capital allocators to acquire XRP exposure through traditional highly regulated brokerage structures, the same structures they use for equities, fixed income, and alternative assets. Anchorage Digital is not a crypto startup. It is a federally chartered bank regulated by the Office of the Comptroller of the Currency. When an RIA acquires XRP through an XRPDR held at Anchorage Digital, they are acquiring a regulated financial instrument through a federally chartered bank. There is no unregulated exchange risk. There is no custody uncertainty. There is no compliance exposure that their legal teams cannot manage. The barrier that kept trillions of dollars in professionally managed capital on the sidelines has been quietly removed, and most of the retail market has not noticed yet. The CFTC and the XRPDR launch are not two separate developments. They are two components of the same institutional access infrastructure being constructed simultaneously. The CFTC establishes Ripple's position inside the regulatory framework that will govern institutional digital asset use. The XRPDR creates the financial instrument through which the capital governed by that framework can access XRP exposure. Together, they form the complete institutional on-ramp that was missing from the XRP investment thesis for the previous market cycle. An institution needs two things before it can make a significant capital allocation: regulatory certainty about the asset's legal status and a compliant financial instrument through which to access that asset. The CFTC forum addresses the first. The XRPDR through Anchorage addresses the second. Both are now in place. And the $520 million whale accumulation that occurred simultaneously suggests that the entities closest to these developments have already drawn the conclusion that retail has not yet reached. Now let us get into the macro data, because this is the framework that explains why the numbers being discussed in CFTC rooms and Anchorage boardrooms are the sizes they are. The global correspondent banking system at this moment requires every international payment to be pre-funded. When a US bank wants to send $100 million to a bank in the United Kingdom, both institutions must hold pre-funded accounts at each other's location. Capital sitting completely idle, earning nothing, simply to guarantee the settlement. Multiply that requirement across every bilateral banking relationship, in every currency corridor, across every country on Earth. The total capital trapped in these Nostro and Vostro accounts, doing absolutely nothing, generating zero return, simply waiting to guarantee settlement obligations that XRP could settle in 3.4 seconds, is approximately $27 trillion. $27 trillion, locked up, idle, earning nothing. And XRP's on-demand liquidity model eliminates the need for that pre-funding entirely. The swift integration dimension of the $27 trillion unlock is a technical confirmation that this is not a theoretical future deployment. It is an architectural connection that already exists. PaymentSafe, a hub that integrates directly with Swift, has demonstrated full XRPL compatibility. And XRP is fully ISO 20022 compliant, natively, without wrappers, without middleware layers, without the technical friction that every other digital asset requires when attempting to interact with the International Banking Messaging Standard. ISO 20022 is the language that banks speak for international payments. It is the communication standard that the Federal Reserve, the European Central Bank, and the Bank of England have all migrated to. An asset that is natively ISO 20022 compliant does not need to be translated to interact with global banking infrastructure. It is already speaking the same language. The architectural bridge between XRP and the $27 trillion Nostro-Vostro system is already built. What remains is the regulatory framework that authorizes its deployment at scale. And that framework is being written at the CFTC right now. The Genius Act's recent passage adds a sequential regulatory confirmation that the institutional timeline is accelerating rather than stalling. The Genius Act provided the initial statutory framework for institutional stablecoin deployment, the legal authorization that allows RLUSD to operate as a compliant institutional bridge product within US financial infrastructure. RLUSD, backed at 105% by US Treasury instruments and integrated with Federal Reserve payment rails, is not a separate development from the Nostro-Vostro unlock. It is the specific product that facilitates the transition from pre-funded correspondent accounts to on-demand XRPL settlement. When a bank eliminates its Nostro account in a particular corridor, it needs a compliant stablecoin bridge to replace the pre-funding function that the Nostro account was performing. RLUSD is that bridge. The Genius Act authorized its use. The Clarity Act markup will authorize XRP's role as the settlement asset beneath it. The $27 trillion is not unlocked in a single event. It is unlocked corridor by corridor as each bilateral banking relationship migrates from pre-funded accounts to on-demand XRPL settlement. The complete picture from today's data produces the timeline that the institutional accumulation pattern is calibrated against with a precision that retail sentiment cannot measure. The $520 million single window whale accumulation happened now, not later, because the entities making those purchases have visibility into the CFTC forum timeline, the XRPDR adoption curve, the Genius Act implementation schedule, and the Clarity Act markup date. They are not buying based on price chart patterns. They are buying based on a documented institutional deployment sequence whose next visible milestone, the Clarity Act markup, will convert the quiet accumulation that has been running for weeks into a publicly visible demand event. Matt Hougan sees this. Anchorage Digital built for this. Brad Garlinghouse is sitting at the CFTC table because of this. And the retail investor who sold during the same window that produced a $520 million institutional accumulation will watch the next milestone from a position they voluntarily exited before the sequence completed. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.